For most people, standard deductions are simple figures related to their filing status or age. But for those who can be claimed as dependents of other taxpayers, calculating a standard deduction is a little more complicated. I'm the Tax Geek, and here are standard deductions for dependent taxpayers, oversimplified. If someone can be claimed as a dependent of another taxpayer, usually a parent, their standard deduction depends upon the nature of the dependent's income. As I've gone over in other videos, income can be divided into two categories, earned and unearned. Earned income is primarily income from wages or self-employment. Unearned income is essentially all other types of income, which can include dividends and interest, capital gains from the sale of investments, rental and royalty income, retirement income and Social Security, and unemployment compensation. If a dependent has only unearned income, his or her standard deduction is $1,250. If a dependent has only earned income, or a combination of earned and unearned income, the dependent's standard deduction is their amount of earned income plus $400. But this amount cannot be more than the standard deduction for the dependent's filing status, which is usually for a single taxpayer, or currently $13,850. At this point, some examples are in order. Willie, age 6, can be claimed as a dependent by his parents Ned and Sofia. Willie's grandfather left him an investment account which generated $700 in interest. Since Willie's income consists entirely of unearned income, his standard deduction is $1,250. Because the $700 in interest is less than $1,250, it doesn't exceed his standard deduction and is not taxable. Now let's suppose Willie is 16 and has a part-time job that paid him $6,570 along with his $700 in interest. Since Willie's income now consists of both earned and unearned income, his standard deduction would be his earned income of $6,570 plus $400, or $6,970. His total income exceeds his standard deduction by $300, which would be taxable. Now let's make Willie age 20 and a full-time college student, and as such, still claimable by Ned and Sofia as their dependent. Now let's give Willie a job where he earned $13,700 plus his $700 in interest. To calculate Willie's standard deduction in this case, his earned income of $13,700 is added to $400, yielding $14,100. However, Willie's standard deduction cannot exceed the amount for a single taxpayer, which is $13,850. Subtracting this amount from Willie's total income results in a taxable income of $550. For dependent children under age 19 or age 23 for a full-time student, excessive unearned income can result in Kiddie Tax, where their excess unearned income is taxed at the parent's marginal income tax rate. Kiddie Tax is oversimplified in 2 videos on this channel, which should show up in a playlist in the upper right corner of the screen, or you'll find links in the description below. Notice that throughout this video, I've used the term claimable or can be claimed rather than claimed. A person eligible to be claimed as a dependent by another taxpayer is still subject to the standard deduction rules for dependents, even if the person is not actually claimed. All these rules are in place to keep parents with high incomes from sheltering their unearned income from taxation by transferring it to their children, who would either not have met their filing requirement or who would be subject to lower marginal tax rates. These rules discourage this behavior, all the while making sure that these same dependents are minimally taxed on the income they actually do earn. And that's how you calculate a standard deduction for someone who can be claimed as a dependent. You'll find additional information and resources on this subject linked in the video description. If you found this video informative, pressing the like button would be most appreciated. Subscribe to the channel to see more oversimplifications of our complex tax system. And your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.